a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about small cap stocks and ETFs. And small caps had a blistering performance in the first half of this year. The Russell 2000 index that surged about 22% through June, and this was its strongest first half performance since 1991. The index also beat the Nasdaq by 9%, and that was its biggest first half outperformance over the Nasdaq since 2001, according to the Wall Street Journal. Now, small caps, as we know, are generally more domestic domestically focused, so they benefit from a resilient economy, rising earnings, supportive trade policies, infrastructure spending, and the recent reshoring initiatives. And most importantly, enthusiasm around AI beneficiaries within the small cap universe also help lift the indexes. In fact, the top performing companies within the small cap indexes came from AI, semiconductors, space, nuclear energy, quantum computing, and biotech sectors. Now, can the performance continue? So, the Russell indexes rebalanced at the end of June. So, the most popular small cap index, the Russell 2000 index, that also rebalanced. And according to Bespoke, 25 best performing Russell 2000 constituents before the rebalance had gained at least 250% over the past year. Amazing performance, and they have all left and now moved on to the Russell 1000 index. In fact, Bloom Energy, ticker symbol BE, that is getting promoted to the Russell Top 200 index that surged more than 1100% over the past year. And in fact, for the first time since 2008, a stock has gone straight from the small cap index to the mega cap index, according to the Wall Street Journal. In fact, if you want to learn more about this company, Bloom Energy, there's an excellent article on homepage of Zax.com. It is by my colleague Kevin Cook. Bloom Energy is the bull of the day, and you can read more about this company and what drove its excellent performance. Now, getting back to small cap indexes in general, then higher interest rates. So, if the Fed raises interest rates because inflation remains elevated, that could pose headwinds for smaller companies. We know that smaller companies often carry heavier debt burdens. Frequently with floating interest rates, so they are more sensitive to higher borrowing costs. They also have limited access to the bond market, so that is why higher interest rates they hurt small cap stocks. That said, the recent jobs report was slightly underwhelming, the chances of Fed rate hikes this year have gone down since the jobs report. Now, there are two very popular small cap indexes, the S&P small cap 600 index and the ETF ticker symbol is IJR, and the Russell 2000 index, that ETF ticker symbol is IW. So if you look at the longer term performance since its inception in May 2000, uh, the iShares Core S&P Small Cap 600 ETF has returned more than 1170% compared to about 812% for the Russell 2000 ETF. And According to a study by S&P Dow Jones Indices, most of that performance differential stems from the S&P Small Cap 600's built-in profitability requirements. So to be included in S&P indexes, company has to be profitable. And over the past year, the Russell 2000 has outperformed the small cap 600 index slightly because many companies which are tied to quantum computing, nuclear energy, and AI, they are not yet profitable, and therefore they are not included in the S&P small cap 600 index. Now, let's talk about these ETFs and another ETF which is slightly different. And yeah, apart from that, you should remember that 40% of the Russell 2000 companies are unprofitable. And as I mentioned earlier, this rebalancing, it used to be annual earlier. Now it is twice a year. Going forward, it is going to be twice a year. This index reconstitution forces selling of winners and buying of losers. Now, the most popular small cap ETF is the S&P small cap ETF, ticker symbol IGAR, which tracks the S&P small cap 600 index, and it tracks about 600 stocks, as the name suggests, and it has 110 billion in assets, charges an ultra low expense ratio of 6 basis points. If you want to learn more about this ETF, you can go to the quote page on site, read our research report articles. Using the link, you can go to iShares webpage for this ETF. You can learn more about the ETF, and the current holdings are Molina Healthcare, Viasat, Bright Spring Health Services, etc. The second ETF that I'm highlighting is IWM, which tracks the Russell 2000 index. And as the name suggests, it holds about 2000 stocks, about 82 billion in AUM. This is slightly more expensive, 19 basis points expense ratio. And again, to learn more, you can go to the quote page on Zacks.com, and using the link, you can go to iShares webpage and learn more about this ETF and its holdings. So most of those hottest companies have already left the ETF. Moog Inc., Cytokinetics, and Bright Spring Health Services. These are the top holdings in this ETF currently. The third ETF that I'm highlighting is slightly different, and this has delivered a better performance over the past year. And in full disclosure, I own it in the ETF investor portfolio that I manage. This holds 120 companies in the S&P small cap 600 index with the highest momentum score. So if we continue to be in a momentum driven market, then the ETF may continue to do well. Has 3.1 billion in assets and charges 39 basis points for its slightly specialized holdings performance sorry portfolio. And if you look at the portfolio, Viasat, Esco, Crystal Biotech, and Mercury Systems, these are the top holdings in this ETF. And Bright Spring is also there, which you saw in the earlier ETF that I highlighted. On the next slide, I have the comparative performance versus the S&P 500 index. The momentum ETF is the best performer. It is up 26% year to date. IJR is up about 23%, IWM about 22%, and the S&P 500 index is up about 10% year to date. Thanks for watching. Make sure to check out zax.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.